So you've heard about the stock market and you know that you should probably invest in it, but have no idea where to get started. If you feel like it's too overwhelming to get started, or if you're asking yourself if there's a huge time commitment, then the answer is no. And if you've ever decided to start Googling this and get inundated with stocks, bonds, index funds, mutual funds, passively managed funds, actively managed funds, and then just give up and put it off for another day, if that's you, then this video is for you. Let's start with what the stock market actually is. Just like a fruit market where you can buy fruits and vegetables, a stock market is a market for companies where you can buy shares or tiny chunks of different companies. Usually, companies issue stock when they're trying to raise money to invest and grow, but they can't get it from private lenders or banks. You can think of each share as a very tiny portion of a company itself. It gives you part of the upside, but also part of the downside. So if the company is losing money, your stocks might go down in value. Or if the company is doing really well, your stocks go up in value. For example, right now, Apple has over 14 billion shares in the market. Buying each share of Apple is like buying a tiny chunk of Apple itself. My goal is that by the end of this video, you've at least opened an account and invested at least $1 somewhere. In order to understand how the stock market works, you need to understand compounding. Compounding is the eighth wonder of the world, is a common quote attributed to Einstein. He probably didn't say it, but it goes to show you its power and relevance. If you've seen one of those TikToks where someone is offering $1 million on day one, or a dollar doubled every day for 30 days, then you probably know the answer to this question. But a dollar doubled every day is over $1 billion. This simple example goes to show you the power of compounding. Obviously, you're not going to get a deal where a dollar is doubling every day for 30 days. If that was the case, everyone would be super rich. Historically, the stock market has average returns of 7 to 9%. Usually, the ballpark figure that's thrown around is around 8%. This is based on historical averages. 8% might seem like nothing compared to doubling your money every day for 30 days, but if you go to one of those compound interest calculators and you start with a principal of $1,000 and you keep on adding $500 every month for about 40 years and you're getting returns of 8% per year, then you end up with, I think, $1.5 million. That's basically the reason why everyone keeps saying you should invest in the stock market. If you invest a bunch of money over the long term, eventually you're left with a lot of money. The key thing here is time in the market. The longer you keep your money in the market, the more time it has to accrue interest and grow. So now, if I've convinced you of investing in the stock market, you'll probably be asking me, what stock should I buy? And that's the wrong question. You shouldn't be looking at individual stocks unless you have some sort of competitive advantage where you understand that stock better than other people, which I'm assuming is not the case for most of you here. For most normal people, to capture that 8% interest, that is based on the overall stock market. You don't have to go out there and buy each individual share to participate in the stock market. Instead, you can buy index funds. According to Google, index funds track the performance of a specific underlying investment. In this case, if you wanted to track the overall S&P 500 or the overall stock market, you could get an index fund that does that for you. Basically, every dollar invested into that index fund, let's say you take something like the WU, which tracks the S&P 500, every dollar invested into that index fund will be split across these 500 companies, not evenly, but based on what their market cap is. This leads me into what specific index funds to buy. Honestly, that's up to you. But for me, I usually buy the VOO, which tracks the S&P 500. The S&P 500 usually tracks the overall stock market in the US, and there's also the VTI, which tracks the overall large cap and small cap US stock market. So this includes all stocks, including the S&P 500. There's two main things that you should be looking at when you're trying to evaluate whether or not you should buy an index fund. First of all, what is the specific underlying investment? Is it tracking the S&P 500? Is it trying to track the international stock market fund? What is it tracking? And then the second thing is the expense ratios. A good rule of thumb is that you should go for expense ratios that are below 0.02%. That's the main advantage that index funds have over actively managed mutual funds. Actively managed mutual funds, as soon as you put your money in, they start charging their fees. And it might not seem like a lot, but let's take that example with $1,000 and you were putting in $500 every month for 40 years. If your returns were 7% instead of 8%, you would be left with $1.2 million instead of 1.5. That's still a lot, but that's $300,000 less. Arguably, most mutual funds underperform the overall stock market. If you just buy the stock market, you're going to outperform the majority of mutual funds out there. In my opinion, there's no reason why you should be buying a mutual fund instead of an index fund. All right, so now you know what to get and what factors to look for when evaluating the different index funds and how to make your choice. Personally, I buy the VTI, which tracks the overall US stock market, and I usually go for Vanguard funds because their expense ratios are super low. But you can just Google around and there's lots of different options out there. You don't have to go with Vanguard. The second thing that I would consider before jumping ahead and buying something is tax advantaged accounts. Most countries have some sort of tax advantaged account. There's two broad categories here that you should be thinking about. Some accounts, you put in your post tax income and the money is exempt from taxes when you take it out. So, whatever interest you gain on that money, that's not taxed. And then there's other types of accounts where for every dollar you put in, there's some sort of tax deduction. Wherever you're living, UK, Canada, US, Australia, whatever, there must be some sort of tax advantage account. They usually have some sort of yearly contribution limit and then they have an overall contribution limit. I would just Google these contribution limits and you should be able to open these accounts with whatever account you're using. That 8% return is based on an average. Usually the stock market is up 30% or down 15%. There's huge fluctuations and variations depending on a whole host of factors that are out of your control. The main thing you should be considering here is consistency and investing for a long time and forgetting about the money you put in there. Initially, when you invest, there's going to be a temptation to keep looking back in and checking your account over and over again. I would just say resist this, put it away, just add in your money and forget about it. Thank you for watching.